Another big day of gains, 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, a relief rally. Stocks rise as President Trump diffuses some tensions over Fed Chair Powell and China trade talks.
Meanwhile, Elon Musk is ready to shift gears, so to speak. He vows to step back from his White House role, easing investor concerns at Tesla.
And troubling signs as more earnings continue to roll in. CEOs haven't been this pessimistic since the financial crisis. All that and more coming up, but let's take a look at stocks under the hood, and we have to start with Tesla, absolutely flying right now. That's after Elon Musk said that he's going to pull back from Doge and focus on the struggling car maker. That's good enough to send the stock nearly 8% higher, Matt.
We'll talk about those struggles. Boeing revenue met analyst estimates as it slowly ramps up production of 737 jets again. The company also burned less cash than previously had been expected.
I've got another story we're watching in the middle of a lot of change. Intel plans to announce more than 20% in job cuts this week in an effort to streamline management. Intel reports earnings tomorrow, and the stock is up pre-market. Katie.
Meanwhile, zooming out, markets breathing a sigh of relief yesterday after President Trump softened his tone on Fed Chair Powell and on China.
No, I have no intention of firing him. I would like to see him be a little more active in terms of his idea to lower interest rates. This is a perfect time to lower interest rates. I think we'll make a deal with China. We're going to be very nice. They're going to be very nice. And we'll see what happens. But ultimately, they have to make a deal. 145% is very high, and it won't be that high.
Let's get the latest from Bloomberg's Tyler Kendall in Washington, D.C. So, Tyler, the president says he wants to play nice after slapping China with 145% tariffs. Is he backing down?
Yeah. Hey, Matt. Well, President Trump does appear to be softening his tone, but there's two big questions here. One, is it enough to get Beijing to the negotiating table? Because up to this point, demanding that Xi Jinping call him directly doesn't necessarily seem to be working. And the second question is, how long will this tone last? Because the White House has made very clear that they need to see a significant rebalancing of trade when it comes to Beijing, and tariffs aren't going to go down to zero. And our reporting indicates that officials still plan to pursue asking our trading partners to curb their own trade with China. Now, the White House press secretary yesterday did say that they were, quote, setting the stage for a deal with Beijing, but fell short of saying that any of those negotiations have actually started. We did hear from China's Commerce Ministry earlier this morning, who said that the door was wide open to talks with the U.S. But at the same time, Bloomberg News had reported last week that there are some important preconditions Beijing has asked for, including that a point person other than President Trump lead the negotiation. There has been some signs of optimism, particularly after yesterday Bloomberg News reported that Treasury Secretary Scott Bessent told a closed-door meeting of investors here in Washington that he's optimistic that tensions could end up cooling with China, and that a trade deal is doable but could likely take 2 to 3 years.
Well, we'll hear from the Treasury Secretary out in public at 10 a.m. today. Looking forward to that. But, Tyler, before we let you go, let's quickly talk about the other reason why you have the S&P 500 up 2.6% pre-market right now. And that has to do with what Trump said about Jerome Powell, saying that he has no intention to fire the Fed chair. That's different from what we heard from Kevin Hassett just last week, saying that he was looking at options.
Right, exactly. And Bloomberg News reporting earlier this week that President Trump did ask his advisors in private whether or not it was possible to remove Powell amid mounting legal questions about the legality of firing independent federal regulators. And President Trump yesterday really saying that the market reaction has been overblown. He never had any intention of firing Powell, but at the same time still suggesting that the Fed chair could be behind the curve, saying that he would like to see Powell early rather than late. But as you guys well know, analysts have been saying that this is a really difficult position for Powell. Mark Zandi of Moody Analytics was just on Bloomberg Television saying that the Fed chair's job has never been tougher because the central bank is stuck between a rock and a hard place when it comes to inflation and weaker growth.
Bloomberg's Tyler Kendall, we appreciate your reporting. We're going to get more from you later. Now, on the earnings front, Tesla surging today despite missing estimates and pausing 2025 guidance until next quarter. Elon Musk said he will refocus on Tesla after months at the Department of Government Efficiency.
Starting probably in next month, May, my time allocation to Doge will drop significantly. I'll have to continue doing it for, I think, the remainder of the president's term, just to make sure that the waste and fraud that we stop does not come roaring back.
Craig Trudell, Bloomberg's global car czar, joins us now. Now, Doge had big ambitions. I don't understand why now he's so ready to step back. Is there any skepticism around his repivoting to Tesla? You know, you don't really see it that much in the stock this morning.
Yeah, I mean, I do think we're seeing a pretty substantial, jump in the shares, but we should keep in mind too that this is a highly volatile stock that's really gotten beaten up, for months now, and I think there's perfectly reasonable questions to ask here about just how much we can sort of take Musk at his word that he's going to substantially step back when he himself is saying 1 or 2 days a week for the rest of the administration. Whenever Trump needs him, he's going to be there. And so this notion that this is going to sort of put to rest, the concerns about any damage he may be doing to the brand and the extent to which he's turning off customers or would-be customers for Tesla, it seems that a lot of those questions are going to take some sort of sorting out in the months to come, depending on just how substantial he sort of takes a back seat here, if you will.
Craig, it's difficult for me to understand why anyone cares if Tesla's car sales drop, because investors aren't paying $700 billion for a car maker here, right? This is a totally different story. Is it a robot maker? Is it a software company, an AI play? What is it?
I mean, I think it's kind of all of the above. And to your point, I mean, this is a company valued in a way that we don't see any other car maker, and valued as a sort of a combination of many of the world's biggest car makers and most valuable manufacturers. And so, yes, they need to deliver on these robotaxi predictions that we've heard Musk make year after year. They likely need to also stand up a humanoid robot business. I think one of the more interesting comments during last night's call was this idea that the trade war with China is potentially setting them back in terms of being able to produce humanoid robots because of the restrictions that China has placed on rare earth metals and the ability for the company to get its hands on magnets for those robots. And so Musk talking about trying to work with China to resolve that. And I think it was interesting that he didn't mince words about tariffs and sort of how he differs from the president while still deferring to him to call the shots in this regard.
All right, Craig Trudell, really appreciate your reporting, talking about Tesla up almost 8% pre-market. To check on the sell side, you had Wedbush raise their price target on Tesla, but you had RBC, Cantor, Canaccord, Baird, Roth Capital all lower their price targets. So let's keep that sell side conversation going now with Jewsikow. He is Guggenheim's senior analyst. He has a sell rating on Tesla. Ron, it's great to have you with us. It was actually a pretty dismal first quarter for Tesla. You wouldn't know it by looking at the stock this morning because there's all this enthusiasm about Elon Musk refocusing on Tesla next month. You're sticking by your sell rating. Tell us why.
Yeah, I mean, candidly, I don't think a lot actually changed last night. I appreciate the shift on Doge being a potential positive for the story, but really we got a reiteration of timelines that we had last quarter. I think the number one driving force for the reaction this morning is the bar was quite low coming into this quarter. Expectations had come down quite a bit. There was risk related to the affordable models, which were reiterated. But overall, just sticking with the June timeline where there is quite a bit of skepticism of Tesla delivering on the robotaxi launch in June. That's enough to lift shares tonight, and certainly kind of trade commentary has been helpful overnight as well in terms of potentially softening of the rhetoric with China. But yeah, results were quite dismal. I think this year this is probably a cash burning business based on our estimates, and I'm not sure related to the vehicle business what we can have confidence gets better even next year at this point, because it continues to deteriorate.
Speaking exactly of that, if you're thinking about the cash burn, you had them trim their spending plans. And even with the CapEx expenditures anticipated to be lower now, What does that mean to you? Does this mean that the caution is warranted, or does it mean that the growth rate is not going to be what investors have been factoring in?
Yeah, it's kind of tough to parse the CapEx cut, because I think a large portion of it relates to kind of the ability to source capital equipment that may have a source of origin from China or some other region where there's currently reciprocal tariffs. So it's tough to parse how much of this is actually a negative shift in terms of the outlook for growth versus kind of a supply-driven shock that will ultimately impact growth, but it's not necessarily Tesla's view on the world changing as much as the trade policy of the world changing kind of dramatically over the last month.
Ron, we kind of joke about Optimus, the humanoid robot, a little bit, but how important is that to the future revenue stream? I mean, I thought it was interesting. He said robo-taxis are going to be meaningful to the bottom line in June of next year, so that's not far off. What about robots?
Yeah, robots are tougher for us to underwrite. I think, given we haven't seen really a primary use case for the product yet, to the extent it's labor replacement, I think people would be surprised that vehicle manufacturing is not terribly labor intense today. It's not insignificant, but it is around 10% of kind of costs within vehicle manufacturing. I think ultimately most investors are far more willing to underwrite robo-taxis, and that is kind of what's implied in shares. I think robots, to the extent Tesla can deliver on their promises, would be positive optionality versus the current share price.
Yeah, the robots are hard for me too. I just know I want them to stay far away from me. But Ron, I want to talk quickly about Tesla's energy business, because Musk has made the case that when it comes to the car business, they're pretty isolated from the trade tensions. But you think about the company's megapack energy storage systems, for example, relying heavily on China. Musk has pointed to this area too as a potential growth region for the business. What do you make of that?
Yeah, I think certainly it will impact the cost of the business this year. The way tariffs are implemented for the vehicle business, they're pretty well insulated. For the energy business, battery sourcing does come from China. LFP batteries are reliant on China for sourcing. I think that it's probably not a tremendous risk to the top line of the energy segment this year, because they do have quite a bit of backlog and they should be able to pass on some of those costs. It probably does compress margins if we're sitting here in the back half of this year and reciprocal tariffs on China remain in place. But I do think that the bigger risk is if we continue to get supply shocks and they just can't deliver on the growth and the capacity that they put in place.
Guggenheim's Ron Jewsikow. Very sorry there, Ron. We are working on it for you. Katie, taking a look at futures here, because I know we are looking at another comeback story.
Yeah, huge day today. It's all about Trump, it's all about Tesla, and it's all about Fed Chair Jerome Powell, of course. Musk softening when it comes to Doge, Trump softening when it comes to China and to the Fed chair. You can see that expressed in futures right now. The S&P 500 up 2.4% after a 2.5% rally just yesterday.
I will say, I hope we can get deeper into it, because there's so much more going on in this market, right? Especially since you see investors buying treasuries, they're buying Bitcoin, but they're shunning the dollar.
Yeah, a lot of different cross currents to explore there. Also cross currents when it comes to the earnings front. We had Boeing this morning.
Yeah, absolutely. Boeing improving its cash burn while stabilizing its production line. We're going to have more on that earnings report next for you. This is Open Interest. Let's get to high interest now. Look at what's making headlines around the world. A forest fire is raging in southern New Jersey. Although evacuation orders have been lifted and a section of the Garden State Parkway that was shut due to the blaze is now reopened, the fire rapidly grew to 8,500 acres in Ocean County, about 90 miles south of New York City. Satellite imagery shows the fire was inching closer to the Oyster Creek nuclear power plant. The facility was closed in 2018. It is now being decommissioned until we need it for artificial intelligence. Apple and Meta were fined nearly $800 million by the European Union for violating new antitrust rules. The penalties were imposed under the EU's Digital Markets Act, which was mainly aimed at Silicon Valley giants like those two. The punishments are far lower, though, than previous penalties under traditional EU law, and may be seen as an attempt to avoid provoking President Trump, who had warned of harsh retaliation. And Goldman Sachs shareholders are set to vote in just a few minutes, or at least the AGM kicks off in just a few minutes on whether to approve $160 million in special bonuses for CEO David Solomon and President John Waldron. The bonus packages are Goldman's way of keeping talent and warding off competition. That's what they say. But the size of the payout has drawn criticism from activists. Two shareholder advisory firms, Glass Lewis and International Shareholder Services, have both pressed investors to reject those pay packages, and they'll vote later on after they do a whole bunch of other ceremonial stuff at the AGM. Katie?
Yeah, we'll keep an eye on that, but we're also keeping an eye on Boeing shares on the rise in the pre-market after the embattled plane maker reported results that beat Wall Street's expectations on revenue. That's as it ramps up its jet production. For more, I'm thrilled to say we're joined by Tony Bancroft. He is portfolio manager over at Gabelli Funds. Tony oversees the Gabelli Aerospace and Defense ETF. He's also a former FA-18 Hornet fighter pilot with the U.S. Marine Corps. So, Tony, you are uniquely qualified here. Let's start with what we just heard from Kelly Ortberg speaking on Arrival Network, saying that the bigger issue on tariffs is supply chain health and that China has stopped taking delivery of its aircraft. I know that there's a lot of enthusiasm right now over the shrinking cash drain that was reported, the plans to ramp up output. But as an investor in this company, how are you thinking through some of the trade risks here?
Yeah, Katie, great to be back. I think, in the near term, Boeing, Boeing was just very fortunate to build up inventory, over the last couple of years, which people thought may have been a bad idea. Now it looks like a really good idea. So I think they're pretty well protected. There was a comment that the other day Boeing made that they're able to find other suppliers for the SPS fire. And, they're going to be able to probably get through this with production, even if there is some supply chain disruptions. But in the long term, you heard CEO Ortberg say this again and again, that this could be an issue. It's a global supply chain. A lot of it, of course, is domestic. But, you got to have every part of the plane in order for it to be allowed to fly. So, they're going to have to deal with that over the long term. But with these retaliatory tariffs, these planes don't, they need a lot of maintenance, right? There's constantly servicing the engines, and these components are going to have to be, an aircraft is essentially a razor blade business, so it needs to be serviced. And I think, I don't know if China and getting into this retaliatory, trade war is going to, for the aerospace industry, is going to do, 60% of their fleet is 50-60% of their fleet is Boeing aircraft. So they're going to need to, get these parts eventually.
Significant risks, but also you have Kelly Ortberg calling this a turnaround year. To the extent that they're starting to make progress on that, what is the next phase of that turnaround that investors are going to need to see?
They're going to have to see the FAA authorize them to go above 38 a month. That's sort of the big ticket item. And they sound pretty confident in that. So I assume that they've been working closely with the FAA, and, they're talking about getting to 42 a month, this year. So I think that's probably what investors are sort of looking to next. This Thoma Bravo sale is a boon for them for their balance sheet, improving that. And then the F-47 win that for the next air dominance fighter is a huge win for the defense business, and you're seeing that business in the commercial business stabilizing. So some good things going on.
Hey, I wonder what you think about military spending overall, Tony. I mean, are we going to be cutting our defense spending, or at least holding it stable as we look to reduce government spending in general?
I think it's probably a little bit misunderstood, I think, by the general market that you've heard you've heard comments talking about cutting the military spending in half. If China and Russia were to, I think all things being equal, that's just not realistic, and I think it's probably more rhetoric. But I think the reality is that you've heard the SecDef talk about readiness and lethality and getting back to that. And I think the spend's actually going to go there. And you've heard about the $1 trillion defense budget. And the reality is that the defense spending is directly correlated to global volatility, geopolitical volatility and stability, which we're seeing probably at a peak right now, one of the peaks. So I think long term you're going to see continued defense spending in the U.S. and, by the way, Europe and all of our global allies are all talked about increasing defense spending.
Well, Boeing shares currently up about 6.5% pre-market. Tony, great to get some time with you. That is Tony Bancroft of Gabelli Funds. And he mentioned that deal, of course, for the Jeppesen unit. Later this hour, we'll speak with Holden Spaht, Thoma Bravo managing partner, about the firm's acquisition of Boeing's flight navigation unit. This is Open Interest. Welcome back to Open Interest. We are 5 minutes away from the opening bell. You can see that we have a relief rally on our hands. The S&P 500 up 2.6%. A lot of those gains coming from big tech, coming from Tesla, with the NASDAQ 100 up about 3% right now. Sonali, what I'm interested to see is what volume looks like today, because we know that trading volume has been pretty light this week.
Pretty light, but at least on a percentage terms, we're seeing a big enough move. Some more movers on our radar, because a lot moving under the surface as well. AT&T subscribers beat after Verizon's miss. You're looking at the stock still down less than 1%, more than 1% right now. Philip Morris, though, still up about 4% pre-market. They boosted their EPS forecast, calling of their cigar business for sale as well.
Calling it off.
Calling it off. Thank you for that. So no M&A there. India considers zero tariffs on Harley-Davidson bikes. Your hogs are up.
I mean, how many people in India are buying Harley-Davidson motors?
Have you driven in India before?
I have not been to India.
Very scary roads.
But I think I would like to do it on a hog. All right, less than 4 minutes until the opening bell. We begin the trading day with Corient's Amy Kong. We are moments away from another big rally on Wall Street. This is Bloomberg Open Interest. I'm Matt Miller. You're looking at a 2.5% gain in futures after a 2.5% gain in the cash trade yesterday. So we could be building on that rally, as it looks like the Trump administration is backing off a little bit of the aggressiveness of its trade war. NASDAQ futures up even more than 3%. So tech stocks getting a bigger gain. Of course, they got hit harder. Sonali always shows us how the Mag 7 have been doing year to date, and they're still all down year to date. Opening bell at the New York Stock Exchange. A couple ETF operators here. The New York Stock Exchange, you've got Victor Agani, co-founder of Long-Term Capital Management, there with his ETF that's just started trading, I guess, in February. And then you've got Rex ringing the opening bell. BMAX is one of the ETFs that we're focused in on, or that Rex is focused in on today at the NASDAQ. BMAX is, I think, a convertible bonds ETF that is all about Bitcoin. And Katie, Bitcoin has been very interesting because it continues to rise even as the market is in turmoil.
Matt, I was going to say, you sound like someone who used to anchor an ETF show, really dusting off your knowledge there. And a crypto show, that's true. A long, illustrious resume for Matt Miller. But let's talk about what's going on with Tesla, because it's still flying this morning after Elon Musk's comment he's going to pull back from Doge and refocus on the struggling car maker. Shares currently up about 6% just on that news, Sonali, even though the first quarter was pretty dismal.
Not struggling today, though, and not struggling over here either. Boeing's revenue met analyst estimates as it slowly ramps up production of 737 jets. The company also burned less cash than expected. Shares up now almost 7%, Matt.
All right, and Intel is another one that's gaining today. On its own news, as well as, with the rising tide, Intel announcing plans to cut 20% of its jobs. The hits keep coming for people who work at this one-time behemoth. 22,000 jobs are going to go at Intel as the new CEO looks to streamline management and get back to an engineering culture. Intel reports earnings tomorrow, so we'll see if it can continue with these kind of gains. Let's discuss with Bloomberg Technologies' Ed Ludlow. He joins us out in San Francisco. So, Ed, they just cut, 15,000 workers last year. Another 20,000 and change are going to go now under the new CEO. Is this really helping the company?
I still think there's a sense that Intel's bloated, right? And what our reporting and the source says is that this effort, this latest one, the 20%, is focused on middle management. So it's a bloat issue, but also a cultural issue. You know, Pat Gelsinger's kind of legacy was that he was ultra focused on Intel becoming a contract manufacturer for third parties. And the product side of things wasn't really ever recovered. It doesn't really seem that Intel's at the cutting edge and competitive on key markets like AI accelerators. So that's the motivation here. Yeah, kind of cut overall headcount beyond the 15,000 they did last year, another 20%, but kind of get a lean and mean vibe going in Intel where they focus on the technology as well.
Well, yeah, just for context, you think about Intel, apparently it had just under 110,000 employees at the end of 2024, right. So still some bloat there. But tell us more about what we should be expecting to hear when they actually take the earnings stage tomorrow. It seems like Wall Street says that the worst of the revenue declines are behind this company, but it's not like they're going to return to maybe some past decades growth levels.
Yeah, I mean, you know, the story on Intel is that they kind of missed the boat on GPUs, right, or AI accelerators for data centers. And they were heavily, at that time in August when they did the last round of layoffs, leveraged towards CPUs. You know, they were offering loads of something that people didn't want as much of. It'll be interesting to see if they've rebalanced. And then on paper, like Intel is the national champion for the United States, right? On paper. It's the biggest beneficiary on paper of the CHIPS Act, which is so uncertain. So it'll be interesting to hear from them how they feel about accessing funds from the CHIPS Act and whether that they can basically put their hand up and say to the administration, help us. We want to do what you're talking about, onshore more supply chain here in the United States. And I think that they will kind of lean into that a little bit.
Ed, I have been waiting all morning for your take on this show on Tesla. Tell us what you got.
Yeah, you know, markets and investors don't seem so focused on sales and profit, right? And I think that we got exactly what the market hoped for, which is Elon Musk just to say the simple thing, pulling back from Doge starting next month, May, and re-emphasizing a commitment to Tesla. A lot of it doesn't add up. I mean, there is a 130-day limit anyway on a special government employee, even if they're not paid. So he would have had to have stopped working with Doge in some capacity by the end of May anyway, based on that 130 days. There are some contradictions in the earnings deck, what Elon Musk said and what the CFO said. If you take your magnifying glass, you can find them. Elon Musk said basically outside of macro issues, there's no impact to demand. The CFO contradicted that and said quite clearly there was the vandalism and brand issue, which hurt demand, changing political landscape, quote from the deck, impacting demand going forward. But on the biggest exposure in the whole tariffs thing, it's definitely China and that energy storage business, where we need to learn a lot more about the proportion of cells that are coming out of the Shanghai facility that go into energy storage products here in America.
Plus, they're going to start producing the cheaper car this half. They're going to do full self-driving, not just Europe and Asia, but in America this year. So there's some really good up-arrow stories there as well. Ed Ludlow, look forward to your program at 11 a.m. Bloomberg Technology. Let's broaden out to today's market rally. We're joined by Corient partner and wealth advisor Amy Kong here in the studio. Thanks so much for joining us on set, Amy.
Thanks.
What do you think about yesterday? We got a flurry of headlines out of Scott Bessent at a JP Morgan meeting, and then Donald Trump. He's going to play nice. He's going to essentially back down a bit on this trade war with China. Does that make you more bullish this market as well?
Not quite there yet, but I certainly welcome some of these relief rallies and essentially just pulling back a little bit. The market is and has been trading on headlines, and it probably will continue to do so over the foreseeable future, just trying to gain some clarity on what to make of the tariff war situation. The good news is we are entering into an earnings season right now, and the hope is that the market focus, if you would shift a little bit more towards fundamentals. But as we saw with Tesla, I think the markets are still very keen on trying to find those macro clues and trying to look for clarity. We do think fundamentals will kick in. We are starting to see estimates come down a little bit, and that's important. But I do think the market is still very market driven.
Well, that's where I wanted to go, that if we do return to that focus on fundamentals as we get into the heart of earnings season, as you mentioned, earnings estimates have been coming down. The ratio of downgrades relative to upgrades, it's been negative for weeks here. So maybe we focus on fundamentals, but it seems like we're going to get some bad news in the weeks ahead.
It's possible that the earnings estimates will continue to come down, Katie. And we started to see that already. I believe that the market was expecting maybe around 14, 15% year-over-year growth. But that's likely to simmer down. It's already down to about 10 to 11%. And we're only 20% in terms of S&P 500 earnings. Don't forget the Mag 7 companies have not yet reported. And that's slated to happen later this week into the coming weeks as well. And that certainly could be, again, a trigger in terms of those earnings estimates coming down a little bit more.
You know, Amy, when I looked at the sectors this morning after the open, you are looking at consumer discretionary really helping lead this rebound. And one thing I think is interesting is if you click through, you would expect it to be so much of Tesla in that. But you see, like Williams-Sonoma and other stocks kind of helping lead the way here too. I think that's fascinating because it shows you people have been really, really, really negative on the U.S. consumer. You even saw some of that negativity float from the staples into the discretionary sector too, or the other way around rather.
Williams-Sonoma is not cheap.
No, not
Me
cheap.
and Sonali both like to cook, so.
A little too much. But, you know, how much do you have conviction in those consumer trades at this point in time, given so much concern around consumer sentiment?
Yeah, absolutely. I think, you know, to your point, the idea could be that consumers are front-loading, not waiting to purchase and doing that now in case the price hikes steepen a little bit more towards the back end of this year. What's interesting is that, you know, the headlines out there are scary. And, you know, what we are seeing is that that kind of scariness is not yet translating just yet into the data points. Retail sales, to your comments just before, you know, have not been suggesting any kind of recessionary signal just yet. And so there could be, you know, the fact that household balance sheets are still healthy and consumers are still spending, or some of it's front loading, as I just mentioned.
So do you think the Fed is going to be able to cut? Do you think the Fed should cut now? We don't see inflation coming back in the hard data, as you point out. And we do see growth slowing down a bit. So why not cut?
You know, as long as the Fed's independence is still in the picture, you know, for as long as they can hold on to that, I think the Fed is still looking for a trend line in terms of the data flow. And the CPI numbers have not been getting worse, but they also have not been moving closer and closer to that 2% target. So as long as they can hold out, I would think that the Fed would want to wait again as far as they can, maybe June, maybe, you know, a little bit in the summertime before their first cut.
May 7th to the next meeting.
That's correct.
I do want to bring us some breaking news here. This coming from the Wall Street Journal saying that China tariffs likely coming down to between 50 and 65%. That is certainly a lot lower than 145%. Trump hasn't made a final decision on China tariff cuts, though, according to the Wall Street Journal. But again, that 50 to 65% threshold certainly giving an added pop to the S&P 500 right now, currently higher by about 2.8%.
You got to wonder if that's just the reciprocal or if it includes the 20% fentanyl tariff.
Hopefully, we'll hear more from Treasury Secretary Scott Bessent on this topic at 10 a.m. But Amy, you just told us not to overreact to headlines, but they are coming hot and heavy when it comes to trade policy, especially. And with that in mind, I mean, as an investor, how do you calibrate? Because, okay, there's a lot of headlines, don't overreact, but it does seem like the world order is shifting a little bit.
No, absolutely. And, you know, the headlines, especially towards the earlier part of this month, have been just very wild, as we all know it. We have been advising clients not to trade into that noise, but certainly we are looking for some of this momentum. You know, we have this 90-day pause. We're hopeful that trade deals can come through, or at least some initial momentum there. And ultimately, what we're telling clients, what I've been telling clients, is to stay humble in this context, understand that volatility is a feature, not a bug of the stock market. And within the stock component, I do think that having exposure to companies that have the scale and the ability to manage through tariffs, pricing power, you name it, expense control, those are, you know, in our opinion, the better way to manage through this chaos. And we certainly do understand that headlines can turn to the negative, as we've seen. But to your point, you know, some of this momentum can actually be on the upside.
Yeah, it looks like the market is staying humble as well, and S&P 500 initially reacting to that news, but cooling off a little bit just off of session highs. Corient partner and wealth advisor Amy Kong, we thank you so much for joining us here on set. Now coming up, Thoma Bravo buying Boeing's flight navigation unit for over $10 billion in cash. Thoma Bravo managing partner Holden Spaht joins us next for today's Wall Street Beat. This is Open Interest.
Welcome back to Open Interest. Let's take a look at this rally right now. You have the S&P 500 higher by 3%. We just had that Wall Street Journal reporting that we're looking at lowering China tariff levels. That's, again, according to the Wall Street Journal, that's good enough for session highs on the S&P 500. The NASDAQ 100 also off to the races right now, higher by about 3.7%. And you have the small caps getting in on this action, up about 3.9%. We do have some breaking data, though, when it comes to this market, you guys.
And this is kind of a pro-Trump data set here in terms of the S&P Global U.S. PMIs. We have better than expected PMI for manufacturing, and it's even expanding. So over 50 on the manufacturing PMI, 50.7, the level there. We were looking for a contraction at just under 50, 49. The services missed, but also expanding. 51.4 was the services PMI. We were looking for 52.6. But I think it's interesting that you get that kind of trade-off, right? A little bit of expansion in manufacturing, Sonali, and you still have expansion in services, but not quite as much as we expected.
Right, but the manufacturing is the point, as you say, for the Trump administration. The S&P gains really elevating off the heels of that news, and also an interesting contrast from Europe, where similar data was disappointing. So back to that Invest in America trade, the one we haven't really seen for days. Katie.
Good enough to keep that rally going on the broader indexes. Let's focus in now on top calls, though. Some of the analyst action in focus this morning. And first up, automotive technology company Mobileye getting upgraded over at BNP. The firm says that gross margins are significantly higher versus its peers because it doesn't make any of its own chips. Next up, we have SolarEdge getting cut to a sell over at Morgan Stanley. The firm citing worsening demand and a negative impact from tariffs and the company's exposure to changes in the Inflation Reduction Act. And finally, Chevron getting downgraded to equal weight over at Barclays. The firm citing expectations of lower oil prices. And this downgrade, it's Chevron's second of the day after Redburn cut the stock to sell, Sonali.
And it's time now for the Wall Street Beat. Today we are looking at Thoma Bravo's purchase of Boeing's flight navigation unit for nearly $11 billion. Joining us now, Holden Spaht, Thoma Bravo managing partner. Holden, I've got to say, you've kind of blown me away by your deal making so far this year. You're stepping in at scale at a time when many people are not. And when you think about this deal in particular, what were the details in terms of how you won it and what Boeing was able to put up to make this deal attractive to you?
Perfect. Well, thanks so much, Sonali. It's great to be on your show again, and especially with such an important transaction announcement. And look, this is exactly the type of business that we look for at Thoma Bravo. This is a market-leading business. Their data and navigational charts really power the commercial and business aviation industry. They're a market leader. It's 90+% recurring revenue. It's 95+% renewal rates. You have very happy customers. It's a double-digit growing business that's very profitable. So this is a very, very, very special asset. Because of that, it also attracted a lot of interest from both the financial buyer community and the strategic buyer community. And I think really what Boeing was looking for really was certainty of closing, speed to signing, and a value that worked for its shareholders. And I think fortunately we were able to provide all three. We developed a great relationship with Boeing. There's still a lot of work to be done to transition this company out of Boeing. But this is a very important company. It's a very important transaction. We developed a great relationship with Boeing, and we're very fortunate that we're able to announce such a big transaction in a time that's relatively volatile.
Well, talk us through how this is going to work going forward, because my understanding is that you agreed to allow Boeing to retain some rights to the data that is generated by these products. There was some reporting that that potentially was a deal killer when it comes to other potential sales here. How is that arrangement going to work going forward?
Yeah, no, this business, Jeppesen, and we spent a lot of time on this, obviously, but it owns all the IP that it's owned historically. Now, Boeing has some internal use. They have some rights to use some of that, but Boeing is not interesting, nor are they really able to compete with us with our own product set. It's very important anytime you do a carve-out to ensure that the business is allowed to get all the IP that it is, and that was a point, obviously, that we needed to, and others needed to negotiate. But to do a deal of this size and magnitude, we have all the relevant the relevant IP that we need to run the business and continue to operate it in the way that it's been run.
We were talking with Tony Bancroft at Gabelli, and I said, hey, man, we got Holden Spaht at Thoma Bravo on later. What would you ask him? He said, well, I'd really like to know what the margins are in that business. Is that something you're able to share?
I don't know that it's been shared publicly, so maybe I'll just say that, I think, look, we have a very special operating playbook when it comes to data and software companies. This company does run at really nice margins already. Boeing has done a really nice job of getting the margins to a spot where they're good. Now, we think with our operating playbook, we can both enhance the growth rate of the business and improve the margin profile over time, which is very consistent with all the other, large enterprise software transactions that we've done. But the margins are healthy operating margins today.
What are your plans for Jeppesen? Are you combining all of these digital assets into a single entity under the Jeppesen brand? You did get other offerings here like Oz Runways, and is the plan to eventually take this public? And what margins will they have then?
Well, I think, look, the great news here with a company like this that's so special, where it did attract so much interest, just like most of our companies, we buy very high quality revenue businesses, and we use our operating playbook, and we've done it for over 2 decades to really enhance both growth and the profit margins of the company. We operate internally, we operate a lot of companies. You hear Rule of 40 in the public markets, which is a combination of revenue growth and profit margins. We operate a lot of our companies at Rule of 50 plus, even Rule of 60 plus, and you've seen some of the deals we've sold like Adenza, Ellie Mae, Frontline. These are all companies that are growing double digits at 50% margins when we sold them. And we think this company has exactly that kind of potential. We're going to carve it out, operate it standalone. And I think in the end, when we're done with our work and we have a great partnership and working on a great business plan, it will be attractive to, just like it was in this time, it will be attractive to the financial buyers, strategic buyers, and the IPO markets, which are frankly very interested now in profitable growth, which is exactly the kind of product that we build at Thoma Bravo.
All right, well, we're looking forward to watching how this business transforms under your ownership. Our thanks to Holden Spaht of Thoma Bravo. Meanwhile, quick check on the S&P 500 soaring right now, up about 3%, hit session highs of 3.4% just a couple minutes ago. Volume off the charts. We'll bring you all the action next. This is Open Interest.
We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. We are waiting to talk or hear from Treasury Secretary Scott Bessent, but let's take a look at these markets right now, because boy, do we have a rally on our hands. The S&P 500 higher by 3% right now. Big tech leading that charge to the upside, of course. And here we have it, some headlines from our Treasury Secretaries.
Yes, the Treasury Secretary, of course, speaking at the International Institute of Finance. He is going to be giving a keynote. What it will include is that he's calling for the IMF and the World Bank to seek reforms after mission creep. We have heard this from the administration for big organizations in charge of the economy before. He says that the IMF must prioritize financial and economic stability. And he says America first does not mean America is alone. So interesting to hear the Treasury Secretary reach out to his financial counterparts around the world at this point in time. He said the Trump administration wants to work with the IMF and the World Bank. Of course, it's a critical time given how much these trade negotiations might change the financial situation across the world from what many of these multilateral organizations will be focusing on.
I think the key headline in that bank is America first does not mean America alone. He is not aiming for a closed economy, as so many others in the Trump administration seem to think is the right answer. Let's bring in Bloomberg's Tyler Kendall in Washington to preview Treasury Secretary Bessent's speech. Tyler?
Yeah, hey, Matt. So we're going to have to wait and see if the Treasury Secretary particularly comments on China, of course, something that we are closely watching after our own reporting indicated yesterday that he expressed some optimism on potentially striking a deal with China, though cautioned it could take 2 to 3 years to actually get one done. And yesterday, we heard from President Trump that tariffs will be much lower than the current 145% levy that's in place. And then this new Wall Street Journal report this morning signaling that the White House is considering slashing those tariffs ahead of time in order to get Beijing to the negotiating table. Their sources telling them that it could be by more than half, in some cases landing on a tariff between 50 and 60%, or perhaps maybe taking a more tiered approach when it comes to this and differing between products that are deemed to be a national security concern or not. Now, we have to keep in mind here, we're seeing these headlines start to cross about mission creep, but also the U.S. wanting to work closely with the IMF and World Bank. I think it's fair to say that under this Trump administration, we haven't necessarily seen as firm engagement with these organizations. For example, the U.S. has often missed some planned internal votes. There also isn't a permanent executive director to either of these organizations, and President Trump hasn't necessarily been shy about his disdain for multilateral organizations. So interesting to see the tone there from these headlines crossing, according to our Bloomberg News reporting, because we are going to be watching very closely the tone as this White House says that it is negotiating with multiple countries. The White House press secretary saying yesterday that we can expect 35 countries to engage with the White House.
Hey, Tyler, let's listen in to Treasury Secretary Scott Bessent as he takes the mic.
It's an honor to be here. In the final months of World War II, Western leaders convened the greatest economic minds of their generation. Their task, to build a new financial system. At a quiet resort high up in the mountains of New Hampshire, they laid the foundation for Pax Americana. The architects of Bretton Woods recognized that a global economy required global coordination. To encourage that coordination, they created the IMF and the World Bank. These twin institutions were born after a period of intense geopolitical and economic volatility. The purpose of the IMF and the World Bank was to better align national interest with international order, thereby bringing stability to an unstable world. In short, their purpose was to restore and preserve balance. This remains the purpose of the Bretton Woods institutions. Yet everywhere we look across the international system today, we see imbalance. The good news, it doesn't have to be this way. My goal this morning is to outline a blueprint to restore equilibrium to the global financial system and the institutions designed to uphold it. I have spent the bulk of my career from the outside looking in on financial policy circles. Now I am on the inside looking out. I am eager to work with each of you to restore order to the international system. To achieve this, however, we must first reconstruct the IMF and World Bank reconnect the IMF and the World Bank with their founding missions. The IMF and World Bank have enduring value. But mission creep has knocked these institutions off course. We must enact key reforms to ensure the Bretton Woods institutions are serving their stakeholders, not the other way around. Bringing balance back to global finance will require clear-eyed leadership from the IMF and World Bank. This morning, I will explain how they can provide that leadership to build safer, stronger, and more prosperous economies all around the world. I wish to invite my international counterparts to join us in working toward these goals. On this point, I wish to be clear. America first does not mean America alone. To the contrary, it is a call for deeper collaboration and mutual respect among trade partners. Far from stepping back, America First seeks to expand U.S. leadership in international institutions like the IMF and the World Bank. By embracing a stronger leadership role, America First seeks to restore fairness to the international economic system. Nowhere is the imbalance I mentioned earlier more obvious than in the world of trade. That's why the United States is taking action now to rebalance global commerce. For decades, successive administrations relied on faulty assumptions that our trading partners would implement policies that would drive a balanced global economy. Instead, we face the stark reality of large and persistent U.S. deficits as a result of an unfair trading system. Intentional policy choices by other countries have hollowed out America's manufacturing sector and undermined our critical supply chains, putting our national and economic security at risk. President Trump has taken strong actions to address these imbalances and the negative impacts they have on Americans. The status quo of large and persistent imbalances is not sustainable. It is not sustainable for the United States, and ultimately, it is not sustainable for other economies. Now, I know sustainability is a popular term around here, but I'm not talking about climate change or carbon footprints. I'm talking about economic and financial stability, the kind of sustainability that raises standards of living and keeps markets afloat. International financial institutions must be singularly focused on upholding this kind of sustainability if they are to succeed in their missions. In response to President Trump's tariff announcements, more than 100 countries have approached us, wanting to help rebalance global trade. These countries have responded openly and positively to the president's actions to create a more balanced international system. We are engaged in meaningful discussions and look forward to talking with others. China in particular is in need of a rebalancing. Recent data shows the Chinese economy tilting even further away from consumption toward manufacturing. China's economic system, with growth driven by manufacturing exports, will continue to create even more serious imbalances with its trading partners if the status quo is allowed to continue. China's current economic model is built on exporting its way out of its economic troubles. It's an unsustainable model that is not only harming China, but the entire world. China needs to change. The country knows it needs to change. Everyone knows it needs to change, and we want to help it change because we need rebalancing too. China can start by moving its economy away from export overcapacity and towards supporting its own consumers and domestic demand. Such a shift would help with global rebalancing that the world desperately needs. Of course, trade is not the only factor in broader global economic imbalances. The persistent over-reliance on the United States for demand is resulting in an ever more unbalanced global economy. Some countries' policies encourage excess savings, which holds back private sector-led growth. Others keep wages artificially depressed, which also suppresses growth. These practices contribute to global dependence on U.S. demand to spur growth. They also lead to a global economy that is weaker and more vulnerable than it should be. In Europe, former ECB President Mario Draghi has identified several sources of stagnation, and he has outlined several recommendations to get the European economy back on the right track. European countries would do well to take his recommendations to heart. Europe has already taken some long overdue initial steps that I applaud. These steps create a new source of global demand and also involve Europe stepping up on the security front. I believe global economic relationships should come to reflect security partnerships. Security partners are more likely to have compatible economies structured for mutually beneficial trade. If the United States continues offering security guarantees and open markets, then our allies must step up with stronger commitments to shared defense. The initial actions from Europe on increased fiscal and defense spending are proof that the Trump administration's policies are indeed working. The Trump administration and the U.S. Treasury are committed to maintaining and expanding U.S. economic leadership in the world. This is especially true at the international financial institutions. The IMF and World Bank serve critical roles in the international system, and the Trump administration is eager to work with them so long as they can stay true to their missions. And under the status quo, they are falling short. The Bretton Woods institutions must step back from their sprawling and unfocused agendas, which have stifled their ability to deliver on their core mandates. Going forward, the Trump administration will leverage U.S. leadership and influence at these institutions and push them to accomplish their very important mandates. The United States will also demand that the management and staffs of these institutions be accountable for demonstrating real progress. I invite all of you to join us in working to refocus these institutions on their core missions. It is in our collective interest to do so. The IMF. First, we must make the IMF again. The IMF's mission is to promote international monetary cooperation, facilitate the balanced growth of international trade, encourage economic growth, and discourage harmful policies like competitive exchange rate depreciation. These are crucially important functions to support the U.S. and global economies. Instead, the IMF has suffered from mission creep. The IMF was once unwavering in its mission of promoting global monetary cooperation and financial stability. Now it devotes disproportionate time and resources to work on climate change, gender, and social issues. These issues are not the IMF's mission. And the IMF's focus in these areas is crowding out its work on critical macroeconomic issues. The IMF must be a brutal truth teller and not just to some members. Today, the IMF has been whistling past the graveyard. Its 2024 external sector report was entitled Imbalances Receding. This Pollyannish outlook is symptomatic of an institution more dedicated to preserving the status quo than answering the hard questions. Here in the United States, we know we need to get our fiscal house in order. The last administration ran up the largest peacetime deficit in our nation's history. The current administration is committed to fixing this. We are open to critique, but we will not abide the IMF failing to critique the countries that most need it, principally surplus countries. In line with its core mandate, the IMF needs to call out countries like China that have pursued globally distorted policies and opaque currency practices for many decades. I also expect the IMF to call out unsustainable lending practices by certain creditor countries. The IMF should push more proactively official bilateral lenders to come to the table early to work with borrower countries to minimize periods of debt distress. The IMF must refocus its lending on addressing balance of payment problems, and its lending should be temporary. When done responsibly, IMF lending is at the very core of its contribution to the global economy. When markets fail, the IMF steps in and makes resources available. In exchange, countries implement economic reforms to resolve their balance of payments issues and support economic growth. The reforms undertaken during these programs are some of the IMF's most important contributions to a strong, sustainable, and balanced global economy. Argentina is a fitting example. I was in Argentina earlier this month to demonstrate the United States' support for the IMF efforts to help the country reset financially. Argentina deserves the IMF support because the country is making real progress toward meeting financial benchmarks, but not every country is so deserving. The IMF must hold countries accountable for implementing economic reforms, and sometimes the IMF needs to say no. The organization has no obligation to lend to countries that fail to implement reforms. Economic stability and growth should be the markers of the IMF's success, not how much money the institution lends out. World Bank. Like the IMF, the World Bank must be made fit for purpose again. The World Bank Group helps developing countries grow their economies, reduce poverty, increase private investment support, private sector job creation, and reduce dependence on foreign aid. It offers transparent and affordable long-term financing for countries to invest in their own development priorities. The bank, along with the fund, provides extensive technical support to promote debt sustainability among low-income countries, which empowers those countries to stand up to coercive and opaque lending terms from other creditors. These core functions of the World Bank complement the Trump administration's efforts to foster safer, stronger, and more prosperous economies in the United States and the world. But the bank, like the IMF, has strayed in certain respects from its initial mission. The bank should no longer expect blank checks for vapid, buzzword-centric marketing accompanied by half-hearted commitments to reform. As the bank returns to its core mission, it must use its resources as efficiently and effectively as possible. And it must do so in ways that demonstrate tangible values for all member countries. The bank can use its resources more efficiently now by focusing on increasing energy access. Business leaders the world over identify unreliable power supply as one of the primary impediments to investment. The World Bank and African Development Bank's Joint Mission 300 initiative to expand energy access to 300 million more people in Africa is a welcome effort. But the World Bank must respond to countries' energy priorities and needs and focus on dependable technologies that can sustain economic growth rather than seek to meet distortionary climate finance targets. We applaud the recent announcement that the World Bank will seek to remove prohibitions on support for nuclear energy, which could revolutionize energy supply for many emerging markets. We encourage the bank to go further in giving countries access to all technologies that can provide affordable baseload generation. The World Bank must be tech neutral and prioritize affordability in energy investment. In most cases, this means investing in gas and other fossil fuel-based energy production. In other cases, this may mean investing in renewable energy coupled with systems to help manage the intermittency of wind and solar. The history of humanity teaches a simple lesson. Energy abundance sparks economic abundance. That's why the bank should encourage an all-of-the-above approach to energy development. Such an approach will make World Bank financing more effective, and it will reconnect the bank to its core mission of economic growth and poverty alleviation. In addition to increasing energy access, the World Bank can use its resources more effectively by starting to apply its graduation policy. This would allow the bank to focus on lending to poorer, less creditworthy countries. This is where World Bank support makes the biggest difference for poverty and growth. Instead, the World Bank continues to lend every year to countries that have met the criteria to graduate from World Bank borrowing. There is no justification for this continued lending. It siphons off resources from higher priorities and crowds out the development of private markets. It also disincentivizes countries' efforts to move away from dependency on the World Bank and toward job-rich, private sector-led growth. Going forward, the bank must set firm graduation timelines for countries that have long since met the graduation criteria. Treating China, the second largest country in the world, as a developing country is absurd. While it has been at the expense of many Western markets, China's rise has been rapid and impressive. If China wants to play a role in the global economy commensurate with its actual importance, then the country needs to graduate up. We welcome that. The World Bank should also implement transparent procurement policies based on best value. It must help countries move away from procurement approaches that prioritize only the lowest cost bids. Such procurement policies reward distortive and subsidized industrial policies that undermine development. They may also stifle the private sector and incentivize corruption and collusion and result in greater long-term cost. Procurement policies based on best value are better from both an efficiency and development perspective, and their robust implementation will benefit the bank and its shareholders. Related to this subject, I wish to send a strong, and I emphasize strong, message about procurement policies as regards Ukraine. No one who financed or supplied the Russian war machine will be eligible for funds earmarked for Ukraine's reconstruction. No one. To conclude, I invite our allies to work with us as we rebalance the international financial system, refocus the IMF and World Bank on their founding charters. America First means we are doubling down on our engagement with the international economic system, including at the IMF and the World Bank. A more sustainable economic system will be one that better serves the interests of the United States and all the other participants in the system. We look forward to working with all of you in this endeavor. Thank you.
Good job. Thank you. Mr. Secretary, thank you for joining us here today, and thank all of you for coming here today. I'm going to point out you have many great lines in this very meaty and comprehensive set of remarks, but you say, I wish to be clear, America First does not mean America alone. To the contrary, far from stepping back, you seek to expand U.S. leadership in international institutions like the IMF and World Bank. I must say there's a collective sigh of relief across this town right now, because the concern coming into this week is that you were going to do exactly what you said you're not going to do, which is the U.S. would withdraw, but you want to lead. What you're asking for is simply getting back to factory settings, right? Focused approach, and deal with the issues that you see are most paramount, correct?
Correct. As I said in my confirmation hearings, I think U.S. engagement with the international financial and multilateral institutions, we should engage, and we should be in it to win it for the American people and for the rest of the countries and for the client countries.
20 years ago, a senior U.S. Treasury official gave a speech very similar to this, calling on the IMF and said the IMF was asleep at the wheel and dealing with imbalances. Hank Paulson started the Strategic Economic Dialogue with the Chinese. Every Treasury Secretary since then have had an approach. So how will you do this differently, and how do you think that you'll proceed in this approach? What is your philosophy? What is your tools, and how will you execute on this?
Well, look, I think that our moves toward reordering the financial or trading system is a start. I think that today, as I reaffirm our engagement, but set up a list of core principles and back to basics for the institutions, and again, being from the private sector, we want to see results, and we want to see timelines that, as you and I were talking about backstage, global rebalancing has been a topic for more than 20 years.
Long time.
And it's, some countries may have a 100-year perspective. We don't.
Right. China obviously is an important part of this administration's foreign and economic policy. You'll be meeting with your Chinese counterparts. What will you tell them in the sense of how they obviously are aware that there's huge imbalances, their manufacturing capacity is enormous, especially in things like automobiles. How will you help them understand that it's not just about talking, it's about executing?
Well, look, I don't think I have to help them understand. I think they understand very well. And it's just a matter of impetus and will. So I believe I first went to Japan in 1990, 91, within 12 months of the peak of the bubble, a decade of that unwind, a decade of malaise. And then in 2012, I ran across a fellow, 2011, he was running for prime minister named Shinzo Abe, and he knew that Japan needed change and implemented it very quickly. 10 years later, more than 10 years later, Japan has had a remarkable economic run. And I think that our Chinese counterparts that will come to this realization, and if some of our policies, sometimes it takes an external push.
Right.
Alternatively, what I have said previously, there is an opportunity for a big deal here, that the U.S. is looking to rebalance to more manufacturing. The identity of that would be less consumption. If China is serious on less dependence on export-led manufacturing growth and a rebalancing toward a domestic economy, I think they use the term dual circulation. Right. Well, right now it's really singular circulation. And if they want to rebalance, let's do it together. This is an incredible opportunity. And I think if Bridgewater founder Ray Dalio were to write something, he could call it a beautiful rebalancing.
Indeed. But a big part of that will also be our own fiscal imbalance. And as you mentioned, we're running deficit 6% of GDP at the top of the cycle. Not sustainable, as you yourself have pointed out. How important is it to also address our fiscal imbalance as part of this larger rebalancing?
Well, it's very important that I think most people in this room are trained economists, and everyone knows that a trade deficit emanates from three things. External trade policies, which we are intent on addressing. And the external trade policies can be tariffs, non-tariff barriers, currency manipulation, and the state subsidy of labor and means of production. Mm-hmm. So terms of trade or trade regulation is one. Two is our budget deficit. So the larger our deficit, the more it creates a demand suck, also pushes up the interest rates. And then three, the level of the dollar. The U.S., we continue to have a strong dollar policy, and the dollar will adjust based on markets. Everyone asks me, well, what does a strong dollar mean? And to me, the strong dollar means having the policies in place to deserve capital flows and have confidence. But it doesn't mean that the price on the Bloomberg screen every day. And it also has different meanings in terms of bilateral the prices. So it's really three-pronged. But Tim, to your question, I have talked about we did not get here quickly with this spending. The U.S. does not have a revenue problem. We have a spending problem. And I have suggested when I first met President Trump to talk about joining his campaign 2 years ago, that we need to get back to a long-term sustainable budget deficit of something with a 3 in front of it, which works. We have 2% nominal growth or 2% inflation, projected 1.8% growth, which I think could be much higher if we implement our economic policies.
You reaffirmed the strong dollar policy first articulated by Bob Rubin. Valerie Giscard d'Estaing in the 1960s talked about the U.S. exorbitant privilege of the dollar. There are some in this town who question that privilege and actually see it as a burden. Do you see it as a privilege?
That the U.S. sits at the center of the global economy is enabled by the use of dollars, and that it's natural that the usage would come down over time. And I think that the U.S. will always, for my lifetime, be the reserve currency. I actually am not sure that anyone else wants it. I can't remember, one of the European officials said today, maybe it was Mr. de Guindos, I can't remember, said, oh, well, the euro could become a second reserve currency. Well, we've just had a substantial appreciation in the euro. For export economies, it's a lot of pressure. And look, I think that the reaffirming our belief in these international institutions is also part of that.
You mentioned the euro. You mentioned in your comments Mario Draghi's report from last year. There was the letter report. Before that, I've been spending a lot of time in Europe. There does seem to be a much more buoyant atmosphere in Europe. They see this as an opportunity for them. I said something about a possible renaissance. I was heckled a bit, but I actually am pretty positive on Europe. Do you think this is an opportunity to shift some of that demand? The world has relied on U.S. final demand to shift some of that demand for Europe. Is this a positive time for Europe?
Look, I think it can be. And it wasn't in a straight line. It wasn't always the way a trained diplomat would have done. But I think we should all congratulate President Trump. He has done what a succession of European leaders have tried to do for the past 26 years, since the advent of the euro, that whether it's the French, the Italians, other European countries have tried to get Germany to increase their fiscal spend and drive the European economy. And that I applaud these nascent efforts, because it's a combination. It's a combination of economic stimulus, and it is a combination of burden sharing on the European continent for defense. And as I've said many times before, economic security is national security is economic security. So if this European plan works, that I applaud it. I had a private meeting with the Spanish finance minister last week, 2 weeks ago, and he said, you're going to be pleasantly surprised with where we go on military spending, and that this 2% number today, he was right.
Yeah. So you're already taking on these tasks. You have China, more consumption, less investment, deal with their manufacturing excess capacity. Europe is a great opportunity. The U.S. rebalancing here, including on fiscal. So what do you want the IMF to do? What would you like to hear from Kristalina over the next couple of days, or the board, in the new direction, again, back to factory settings direction? What do you want to hear from them?
Well, again, I think it's just been mission creep.
Yeah.
And just occasionally you have to trim your garden when the weeds grow. And I think that it's back to basics. What are our priorities, and how are we going to judge success?
And the World Bank, you discussed about graduating the medium-sized countries that should have graduated some time ago. That changes the commercial model of the World Bank, but obviously you think that's important, that they need to be graduated.
Yes. Yeah. I mean, it's just, as President Trump says, it's common sense that you can't have the second largest economy in the world And it's as I said in my speech, I applaud their rapid growth, but you don't get both. I have a teenager who sometimes wants to be treated like a child, sometimes wants to be treated like an adult. And
I got one of those too.
Yeah. And it's an adult economy.
You mentioned energy, specifically nuclear, during the campaign, and since you've become secretary, you've talked about energy production is one of your important legs. The U.S. produces about 13 million barrels of oil a day, the largest producer in the world. What more do we need to do here, and how can the World Bank, what do they need to do more to encourage fossil fuels as well as nuclear, and I assume all the above?
Yeah, look, the sine qua non for economic growth is energy abundance. And we need to drive the right combination of the crawl, walk, run for these countries in terms of sustainable production. But by sustainable, I mean robust and baseload, not what I would call almost a luxury belief that we have in the West. Like they are worried about pumping water. They are worried about heating their homes, running their hospitals. And we've seen that the intermittency doesn't work. Even kind of in middle developed countries, maybe like South Africa, that seems to have rolling blackouts. Right. So that's not a model. We want to have a model of strong baseload and then bolting on the alternative production, as opposed to beginning with alternative production and then having this latency or intermittency that makes it impossible to industrialize.
In the final minute or two, let me just turn to financial intermediation. There's a famous adage that capitalism without capital is just another ism. The institutions you see here are important intermediaries, both in the capital markets and in other forms of financial intermediation. What is your vision, especially for the U.S., in terms of financial regulation? What do you want the industry to look like? Obviously, the capital markets, the U.S. is the crown jewel of this economy. How should we encourage that not only here, but abroad?
Well, I think that I've been getting a lot of questions on private credit. And I think that private credit is an interesting addition to the U.S. mosaic. And it is the depth and breadth of our capital and credit markets that powers the U.S. economy. And it's the innovation there. I think that private credit's a very new and interesting part, but it is happening outside of the regulated ecosystem. Right. And I always like to say, I'm not an economist, I'm an economic historian, and I think that is a distortion of the system, and it tells me that the post-2008 regulatory corset is too tight on the regulated institutions, and we want to deregulate them or make them more able to provide the opportunity to lend to the American economy and perhaps into the international economy in a smart, safe, and sound way. As we've seen, the history of financial crises is a overreaction on one side, and I think that we had a regulatory overreaction. I convened something in the U.S. called FSOC, the Financial Stability Oversight Council, which convenes the regulators. And I think through partnership with the 3 U.S. banking regulators, Federal Reserve, Controller of the Currency, and the FDIC, we can come up with a system that makes the regulated financial system prosper again. And what the U.S. has that is different than most other G7 countries is just the number of financial institutions. We don't have 5 big banks, 3 big banks. And in the U.S., the community and small banks, which are provides 70% of agricultural lending, 40% of small business lending, 40% of real estate lending. And in the U.S., we've had this incredible boom on Wall Street. I think Wall Street can continue doing well. But I think it's Main Street's turn to share in the prosperity. And I think it was the pullback by the small banks, the post the GFC, that's kind of created this stagnation on Main Street. And we're determined to fix that.
Mr. Secretary, I always say Treasury is the sober voice of reason. What we've heard today from you is a sober voice of reason. We wish you all the best. Ladies and gentlemen, a round of applause for Treasury Secretary.
Thank you.
That was Treasury Secretary Scott Bessent at the IIF talking about the fact that he views America First not as an America alone policy, that the U.S. seeks deeper integration into international roles at places like the IMF and the World Bank. He also noted the substantial increase or appreciation of the euro versus the dollar as European countries are spending more, and talked, I'm sure Sonali's ears perked up, about the importance of private credit in this market, and said it's a great addition to the U.S. capital markets. Let's bring in Saira Malik right now, Nuveen head of equities and fixed income, as well as a CIO there. And Saira, you know, I think most interestingly is still his the first headline that we got out of his speech. It's not America alone. America First does not mean America alone. And of course, that comes together, dovetails with those comments he made yesterday at J.P. Morgan about the fact that it's unsustainable, this kind of trade war we're in with China, and that Trump may cut tariffs by almost half. How much confidence does this give you in U.S. assets?
Well, markets will welcome the America is not alone strategy. It takes that worst case off the table, which we were starting to see with 10-year yields and with the U.S. dollar weakening. The worry that America would no longer be viewed as a safe haven. So that worst case taken away from the table. I think, you know, what we saw today was a very strong step in the right direction. And it told us today that Liberation Day likely was peak tariff day. So really two things to focus on here. Over the short term, very positive to hear that negotiations and discussions will be ongoing. Over the long term, this is about rebalancing global supply and demand, and I think we will make progress on that. For the market's point of view, you know, from starting this week down so significantly on the U.S. markets and recovering so strongly for two reasons. Number one, progress on tariffs, not only with China, but also with India, two very large emerging markets countries. And then secondarily, Trump rolling back any rumors about whether the Fed can remain independent and whether Jerome Powell can keep his job. I think markets appreciate all of that clarity, takes that worst case off the table in terms of whether the U.S. is a safe haven. But what we still need to worry about is what does all of this mean for the economy, and will we be able to skirt a recession or not?
So, speaking of that potential, you are seeing, based on those more comforting headlines, let's call it for a moment here, the S&P 500 near session highs, as well as a bid back into the bond market, as well as into the dollar. You had Secretary Bessent say that he wants to maintain that strong dollar policy. But we also had economic data today that was a little more promising than perhaps investors had expected on the manufacturing front. What sort of knife's edge are we standing on, Saira? Because if you're looking at the future economic data, it still doesn't show a lot of the back and forth of these negotiations. Do you feel confident to dip in the way people are today?
Well, definitely the economy is the key risk from here. And we're in the middle of first quarter earnings. And you're right, all the economic data that we're seeing, it's all backward looking. And so is earnings. And the outlooks from companies during earnings conference calls has been very murky to no guidance to pulled guidance. So our view on what do tariffs mean for the economy at a level of about 10% tariffs across the board out for countries outside of the U.S., that could be an impact to GDP of about 1.5%. And an impact to inflation, increasing it by about 1%. Now, if you put all that together, it basically allows us to skirt a recession barely. So it doesn't necessarily mean at this level, if that's what we end up at, that we will hit a recession. Now, I think the markets probably have seen their lows at the level they got to post-Liberation Day. But if we were to hit a recession, likely the S&P would bottom at 4,700. However, I don't think we're going to see that. Now, as for today, going forward until we have clarity on where tariffs end up, I think the markets are in a trading range, so tough to jump in and buy today. I think what we'll see is a lot of short covering.
Yeah, very tactical environment. Sarah, I want to get your thoughts on something else that the president said. Obviously, we're very focused on trade today, but he also said that he has no intention of removing Jerome Powell from chairmanship of the Federal Reserve. Now, this is something that has been weighing on the market all week. Now it seems that, at least for now, that cloud has been removed. But I wonder how you think about how the Fed makes policy in this environment, clearly still under a lot of political scrutiny right now.
Well, Jerome Powell does bring certainty to the markets because we have history with him. I think more importantly, though, it's that the Fed overall needs to remain independent. Jerome Powell has said that tariff-related inflation, he would view it as transitory and a one-time bump to inflation. So our estimate is still that we can get 2 rate cuts this year starting in the summer of 2025. And that'll be the balance for him. He needs to balance the uptick in inflation due to tariffs with the downtick in the economy that we think we will see. How do you balance that and give us the ability to skirt that recession? It's going to be a fine line, but I think that'll be his target, and that's why you end up with 2 rate cuts instead of incrementally more than that.
I still can't get over the fact that Jerome Powell brought back transitory. I thought we were done with that word, but Sarah, we have to leave it there. Great to get some time with you. That is Sarah Malik of Nuveen. Meanwhile, continuing the conversation on trade, companies from all industries are shifting production due to tariffs. Frozen yogurt company 16 Handles is moving all furniture and millwork production to the U.S. to avoid tariffs. It also needs to figure out how to handle its disposable paper goods products, which are made in Taiwan. Here with us now is Neil Hershman. He is the CEO of 16 Handles. The company was founded in New York City, has nearly 40 locations, and has plans for 25 more across the U.S. Neil, it's great to see you.
Yeah, thanks for having me.
So we're going to have a very serious and sober discussion on tariffs, but I have a really burning question that I've been asking for years. Back when I was a teenager in the 2010s, you could go anywhere and run into a 16 Handles or some other sort of frozen yogurt, serve yourself sort of shop. It feels like we just have seen a massive culling. What is happening?
Yeah, so some other brands have definitely shrunk over the years. 16 Handles has continued to expand. And this is really a growth effort that we've just started over the last 3 years with 16 Handles, taking it from a New York brand to become a national brand. So
I share her concern because I, too, don't find enough frozen yogurt in New York City.
It's so hard.
You know, it's just not out there. But anyway, I will search for 16 Handles specifically. How have you dealt with these tariffs? Katie went through a number of strategic moves that you've made to bring certain things back. Others you have to still plan for. How's it working out for your business?
Yeah, the uncertainty has been difficult to manage, to say the least. But what I would say, to try and turn a long story to a short story, is when the 2018 tariffs happened in China, we had to take a 25% tariff, right, on all of our goods. A lot of disposable paper goods are made in Asia, in overseas, where the labor is a lot cheaper. It just makes sense for these industries. And so as this tariff went on, we decided to move some of our production then to Taiwan, which had a 0% tariff on disposable paper goods. Fast forward.
But did you eat that cost, or did you raise prices?
So we were able to effectively mitigate it and end up in kind of an equal balance. But now Taiwan is being threatened a 30% plus tariff on these disposable paper goods. Right now it's that 10% during that 90-day or the 90-day negotiating period we have. But that's the big question, is like, what's going to happen? And we still produce a lot of goods in China. The plastic goods, injection molds, is a big specialty of China. So our plastic spoons, the plastic lids, and this is for 16 Handles, but for like every company that's got, you know, to-go containers. And so those are currently a 25% tariff. Now the containers on the water, plus the containers we've all ordered because we need goods. It's the summer for frozen dessert. Of course, we have a lot going on. It's going to be an interesting question. Is it going to be 120% additional tariff? Because then it's a few cents on every single to-go cup, on every single order. And that adds up for, you know, a 16 Handles, a Dunkin' Donuts, a Chipotle, whatever brand you want to say. We're not going to eat that margin forever. So at some point, it's going to get passed on to the consumer, and, you know, in the short term, it may get passed on to the small businesses who, you know, the food service industry is known for operating on slim margins. So it's definitely, you know, a big question. But to be honest, the infrastructure is just not there to do these disposable paper goods in the U.S. right now. So there's not really a choice. And, you know, if the goal is of this administration to bring that production and manufacturing here. I think there's other ways to do it other than just these tariffs that are going to hurt small businesses.
An average cup at 16 handles, and I too am a big consumer of 16 handles, so I've often had it for dinner, to be honest with you.
Yogurt for dinner.
Yeah,
I like it.
I put fruit on it though. An average cup is approximately $9 to $10. I remember when I used to buy salads at $9 to $10, right? So what more could this cost, and could you pass those off to consumers at a time where people feel a little pinched right now?
Yeah, so the goal is no. We do see ourselves as a luxury brand, a luxury dessert option, but it's still meant to be less than $10 a cup. Our average check is $12. That's obviously multiple people usually. So, some people getting $7, some people getting more. The goal is to keep it cheap. So we want it to be affordable. We want you to go have dinner, or even if you end up eating in, then come to 16 handles, or you can skip dinner and get dessert, which is something my family does too.
So a small, it's an affordable luxury.
Exactly.
It sounds like is the placement there. I want to talk about how this impacts your future planning. As I said in the intro, I mean, you have plans to open, I believe, 25 more locations of 16 handles, but depending on where trade negotiations go, no one really knows what's going to happen here. I mean, could you see yourself pulling back when it comes to those opening plans?
Yeah, so we're planning on opening like 200, 300 stores. The 25 are actually in development right now. So no, we think this is the right time to expand. The market, like you kind of have said, has gone stale in frozen yogurt and frozen dessert. There's a great opportunity for 16 handles. People in New York know us. People on the other side of the country don't really yet, but they're going to find out about us. And we're just going to keep improving our product. Like you said at the beginning, the millwork, the furniture, the countertops, the seating, all that, we used to produce in Mexico because carpentry was a specialty export of Mexico. But with the customs delays and the added tariffs, it just doesn't make sense anymore. So now we're producing that all in Georgia, and we worked with factory there, and we're able to get the prices actually better than what our old Mexico prices are. So there is a way to grow in this business and be successful without all these tariffs. And all of our frozen yogurt, all of our food is produced right here in the U.S. It's really just certain disposable paper goods, which is like a very labor-intensive, not quality American factory job to create that's imported in. And I think those are the right industries to import, right? There's no national security interest. There's no intellectual property in packing, gluing, folding paper cups. It's a good thing to import.
That's something you plan on having your kids do in the future, right? Make disposable paper goods.
Yeah, exactly.
Neil, great to have you here. Really appreciate you joining us on set. Neil Hershman there of 16 Handles. Have either one of you girls seen the John Hughes classic 16 Candles?
Oh, of course.
Yeah.
No.
The Molly Ringwald. You haven't?
I've heard of it. I get the
All right.
reference.
I really think you should take the time to watch it.
I really think we should take a look at what the heck is going on with the S&P 500. Up 3% right now. I want to highlight volume because it is 25% above the 30-day trading average when it comes to the S&P 500. We've been in sort of a volume vacuum over the past few days, but now we actually have some meaningful news here, some meaningful catalysts when it comes to those easing trade tensions. That cloud over Jerome Powell has been lifted, at least for the moment right now, and you're definitely seeing that in these markets, Sonali.
And we're going to talk a little more about earnings as well, because that's underpinning these markets. But not since the financial crisis have you seen this kind of gloom. According to a quote in a Bloomberg story today, a $500 billion backlog to one company is giving flexibility to navigate the environment. And expensive goods are really starting to plague companies across that S&P 500 and NASDAQ as well. We're going to bring in Alex Semenova of Bloomberg News, who has been tracking that sentiment. What are you hearing?
Yeah, so obviously markets are seeing a little bit of reprieve today with the tariff headlines, but if you look at earnings calls so far, they're actually flashing a little bit of an ominous signal about what's to come for corporate America. CEO commentary on economic conditions hasn't been this pessimistic since the global financial crisis. Bank of America did an analysis where they assessed key words during earnings calls, mentions of words like stronger or better, the ratio of them compared to more negative sentiment like weaker or deteriorating actually is the lowest since 2009. So really getting a sense that companies are flying blind here through these tariff headlines and concerned about the outlook. And guidance has been so important this earnings season. We saw companies like ASML saying that they don't know how to quantify the impact of tariffs. Obviously, Kimberly-Clark yesterday reduced its outlook for its earnings given the uncertainty about the impact of the trade policies. And investors are punishing some of these companies. Citigroup data found that some of the companies that kept or raised their guidance saw an increase of about 1% in their stock on average the subsequent day, versus companies that cut their guidance saw a drop of an average 4.8% in the following trading day.
Just want to talk about some of the companies that are doing well after earnings. Tesla, for example, missed earnings expectations, or they were pretty gloomy if the outlook was suspended, but still the shares were up.
Yeah, we got to leave it there, Alex.
Wait, do you not want to hear what she has to say
I
about
do,
Tesla?
but we have 30 seconds left of the show.
She could wrap it in 30 seconds. Can you give us Tesla in 30 seconds?
Tesla in 30 seconds. Here we go. So basically, as you said, Matt, it's not about the numbers here. It's about CEO Elon Musk coming out and saying that he's going to refocus his attention as being CEO of Tesla. Obviously, the main concern from investors was that he was distracted by his responsibilities from Doge. A lot of investors were calling for him to turn his attention back to the company. And he really read the room here. And investors are, seeing a little bit of a relief rally with those companies.
All right, Alex, masterful job. Tesla shares up 8%. That does it for Bloomberg Open Interest. We'll see you tomorrow.